So this was 2000 when I was in business school, and the internet was still coming about. Businesses, if you remember the dot-com bubble. So I was really starting to get not just learning about the technology and deploying it, but how it could be married with businesses to make them more efficient, or even as a product in and of itself. So while I was at Georgia Tech, through a group project, I started one of the first internet cafes in Atlanta. Internet cafes were unheard of. And so we at the business school took it upon ourselves to partner with a cafe in downtown Atlanta. And we started one of the first internet cafes in the city. And being that my parents were from Nigeria, I started to witness the internet trends in Atlanta and was transposing them on what those trends could be in Nigeria and in Africa at large. And I really started to think about how I could bring this technology into that part of the world. Well, I graduated from Georgia Tech, now right in the midst of the dot-com bubble burst. And I pivoted, and I ended up pivoting into investing. During that time, I made my first angel investment. One was an investment in a media company based in Hollywood. And through the power of social media, I made my first angel investment in Africa in an agriculture company in Uganda. So I really started to see and take advantage of how fundraising and finance was being democratized by technology and becoming more accessible to more of us, and into the continent. So fast forward 6 years, I launched FM Capital Group to make venture capital more accessible to more individual investors. So currently I work with angel investors, and we invest in startups at the early stage in companies in Africa and Latin America. So my experience has really enabled me to become an investor, and I've seen the parallels and patterns in Silicon Valley and how they translate into a different region, giving me the experience to invest cross borders. So this is the work that I love to do. I'm really passionate about it. And so to further this work, I am raising a venture capital fund as general partner of 321 Ventures, to invest at the growth stage. So a little further up in a company's maturity. So I'm here tonight to give you a primer on the actual investing that is happening in the global South. So I want to really talk about what it really means to invest cross borders in Africa. Okay. So this is kind of our agenda for tonight. We'll define the global South, and it means a lot of things to a lot of people. So just want to put us all on the same page, then really talk about and define the opportunity. Why is such an amazing opportunity? Obviously, we're talking about investing, so I'm going to lay out the risks, and I want to let you know what the funding landscape looks like for businesses on the continent. Okay, so the global South, if we start in the Western Hemisphere, it includes Central America, the Caribbean, South America, and then moving east, Africa, and further east, it also includes Southeast Asia. So this is the global South, and this is what I believe is actually the final investment frontier. So this thesis in action. So Migo is a startup company that launched in Nigeria in 2016. Oh, I'm sorry, I can't see my bullets here. Oh, I'm sorry. Okay. Launched in 2016. They offer instant loans to consumers, and then later expanded their offering to businesses so that businesses could offer financing to their consumers. They launched with a seed valuation of just $964,000. And later, when they raised their Series B round just in 2019, the company was valued at just over $40 million. Migo has since originated more than 3 million loans for more than 7 million customers. And with that Series B round that they raised last year, they're now expanding from Nigeria into Brazil and then into Mexico starting this year in 2020. Another company, Paga, was founded in Nigeria in 2009. And Paga is like a Venmo or a PayPal for Nigeria. They do peer-to-peer cash transfers. And they started off with a seed valuation of just $1.4 million. And when they raised their Series B round, also last year, they were valued at $70 million. All right. They acquired Aposit, which gave them entry into the Ethiopian markets. And Paga has since processed over 104 million transactions worth $6.6 billion valued in this year of 2020. And they're going to use the money from their latest round of funding to expand from Nigeria into Mexico and into the Philippines. So this is one of the reasons why I believe that the global South is an amazing trend. Our final example of this thesis is Flutterwave. Flutterwave launched in Nigeria in 2016, and they're also a payments processor for businesses to take payments online from every country in the world. So allowing companies in the global South really to finally take payments online. They started off when they went to market to get funding, they were valued at $1.7 million. And they just closed their Series B round in January of this year, valued at $210 million. So just in 4 years, they've grown from 1.7 to $210 million. Flutterwave has processed over 107 million transactions worth $5.4 billion as of 2019. And the earliest investors in those companies, the angel investors, investors like ourselves, investors like my clients, they exited during that Series B round at a 27x multiple, which is pretty tremendous. So if you think about for every $1 that they invested, they received $27 back in just 4 years' time. So this is why I believe that the Global South is such a tremendous opportunity. So let's find the reasons why companies like Flutterwave, Paga, and Migo are able to garner in such high valuations so quickly. The first trend is that 31% of venture capital is flowing into deals outside of the US. So American investors are starting to understand that the US market is saturated. And more than that, or because of that, valuations for companies originating in the US are very high. So we can see that in 2004, 85% of US venture capital was going into US based companies. And in just 14 years, that has completely flipped. We're now 40 from 15% in 2004. In 2018, 46% of US based money or venture capital money are going into deals outside of the US. Now, the reason for this, why is this happening? The first and biggest reason for this is valuations. So I want to take you on a valuation journey here. And I don't want to get this wrong. So here we go. So I'm always really excited to say that African startups are producing exits for investors, which is really important, right? We make investments, we want to know that we're actually going to receive a return. And investing in African startups absolutely provides not only returns, but actually provides outsized returns. And so, just to give you a context, industry standard or expectation for a return in venture capital is about a 10x multiple on your money. So we've already seen that Flutterwave offer their earliest investors, their angel investors receive a 27x multiple. So let me take you through some other companies, including Flutterwave. So Paystack is a fintech company. And in its first round of funding, they were valued at $1.7 million. And they were actually acquired. They are our first African exit with a Black African founding team that has made its exit on the continent. Stripe acquired them just 2 months ago in October for $200 million. And those earliest investors, those investors in that company all received around 100x return on their money, really in just 4 years. M Pharma is a health tech company, and they, in their first round of funding, were valued at $10 million. And their latest round of funding, they were valued at $48 million. And they actually, in their latest round of funding, were able to vest their earliest employees to the tune of $1.2 million, really making the case for equity compensation on the continent. I think many of you know most people want to be paid, with money and don't necessarily want to take on equity or stock options. So it's not really a form of compensation that happens frequently on the continent. And M Farmer and other startups are starting to kind of educate employees and convince them, and then show them with actually buying them out if they so chose at that time. That's the way M Pharma did it. To show folks that equity compensation is a viable means for being compensated, and you can actually receive money from that. So that was a great development that occurred in 2019. And Della, many of us know, is an edutech company, and its second round of funding was valued at in its second round $33 million. And in its latest round of funding was valued at $700 million. And those earliest investors exited at a 60x multiple in 2017. iRocco is a streaming media company, often called the Netflix of Africa. And its first round of funding was valued at $800,000. And in its latest round of funding in 2016 was valued at $50 million. And those investors, the earliest investors, received a 30x return in 2016. And iRocco has announced plans, 2019, they announced plans to list on the London Stock Exchange, which will be an IPO for them. They planned that in 2021. Then we have Flutterwave, again, just to go through their journey. $1.7 million in 2016 was their valuation, valued in 2020 at $210 million, and had a 27x multiple return for those investors. And then we have InterSwitch. InterSwitch is another fintech company. In its first round of funding was valued at $300 million, and in 2019 became Africa's first unicorn, valued at $1 billion. That funding produced a 14x multiple for them, for investors in 2011. They also announced plans to list on the London Stock Exchange in 2022. And then we have to talk about Jumia. Jumia, when it started fundraising, was valued at $270 million. It's been called the Amazon of Africa. In 2019, they actually IPO'd on the New York Stock Exchange, making it the first African-based company to list on the New York Stock Exchange, and IPO'd at a valuation of $1.3 billion. So exits on the continent are happening. And so what makes the continent really attractive for early stage investors, angel investors, again, are the valuations. The valuations are typically around $1 to $6 million at the early stage, the average being around $3 million, but there's still a lot of companies with traction that are valued below the 1 million mark. So we saw the streaming media company that was valued at $800,000. And these are companies with traction. So they have users, they might be making money, and they're still valued at a low rate, at a low value. And the reason for this many times is because the cost of living is much lower on the continent. Wages are lower, and our exchange rate of the US dollar, our dollars go further there, and the purchasing power of the local currency is lower. So it makes for, relatively speaking to other parts of the world, valuations on the continent are actually very attractive to early stage investors. And so if we look at typical funding rounds, the pre-seed round, which is your earliest stage round in venture capital, this is really before, typically before a company has a product, or or is probably in testing, pilot or beta testing. Those rounds are usually raising $30,000 to $600,000. Valuations can go from $300,000 all the way up to $4 million. Then at the seed round, this is where a company has a product, it's in the market, and now they're ready to grow. They usually raise around $250,000 to $5 million at evaluations that go from $2 million to $12 million. And then you have your Series A rounds, and these round sizes can be anywhere from $2 to $14 million at valuations from $10 to $49 million. So again, in the early stage is where angel investors like to come in before the Series A round, and you can see why the valuations are much more attractive, and you're able to purchase more of the company. The second reason is traction. So African startups and companies are growing. On the continent, back in 2012, there were only 22 tech hubs on the continent, in a few countries, right? And in 2019, that number has exploded in just 8 years to 618 companies, tech hubs. And so these tech hubs are really the centralized common places where innovators, entrepreneurs can come, have reliable internet, reliable connectivity, and really have programming accelerator programs to really bolster their companies and also give educational support around business processes and things like this. The growth of tech hubs has exploded to even countries that did not have any just 8 years ago, like Mali and Zimbabwe. They now have tech hubs as well. So tech is exploding on the continent. And as a result, companies are starting to really gain a lot of traction. So just going over the same handful of companies that we looked at in terms of their valuation, the reason why they got there are these numbers here. And InterSwitch was started in 2002. It's a fintech company. It is revenues as of between 2017 and 2019. They had a revenue growth of 17%. And their margins grew from 17% to 40%. iRocco, which started in 2011, it's a media company. They saw revenues of only $1.2 million, and that was in ad revenues in 2011. In 2014, they made the switch from ad revenue to subscription model, and everyone thought that was crazy, and no one would pay for streaming Nollywood movies. And they, in 2017, reported earnings of $11.1 million due to annual subscriptions. Jumia started in 2012, launched in 2012, an e-commerce company. In 2014, they had 6.8 million euros in revenue. And by 5 years later, by 2019, had 160 million euros in annual revenues. Okay, there we go. Okay. So M Pharma launched in 2013 as a healthcare company. And it's had, in 2018, it was serving 110 pharmacies with more than 20,000 customers coming in and out monthly. And in the following year, just 1 year later, they were serving over 270 pharmacies, so more than doubled their business, and serving more than 43,000 patients monthly. Andela launched in 2014. And in 2019, they saw $50 million in revenue just in 5 years. They were placing 72 developers in 2015, 600, that grew 5 times to 600 developers in 3 years. And then in 2019, they reported that they were placing 1,175 engineers. So you can see the growth that's happening in some of these companies. Flutterwave launched in 2016. In 1 year, in launching in 2017, they had processed over $1.2 billion in transactions, which equaled around 10 million transactions. And then 2 years later, increased that 5 times to 5.4 billion in transactions with over 170 million transactions. And lastly, with Paystack, also launched in 2016, in 3 years, started doing $15.4 million in annual revenues. In 2016, when they launched, they had processed just $550,000 in transactions. In a year later, they increased that to 6 million. And then in 2018, were doing $20 million in monthly transactions. The final reason, so let's talk about the market. We want to talk about the addressable market. The Global South actually provides opportunities to invest in companies that not only take advantage of this growth in this market, but are also becoming the engines of this growth. So first is the population in Africa is young and growing. So this right here is the African column right here. Half the population growth by 2050 will come from Africa, and representing 362 million people between the ages of 15 and 64. And you can see here when we're talking about the time frame between 2015 and 2050, Africa's projection is the only one that's going up. Everyone is either stagnating or declining. Africa's middle class is the second fastest growing middle class in the world. So these blue, so just to explain this graph, which is a little difficult to see, but the blue circles show where we are now in 2020, and the gray circles show where we will be in 2025. The size of the circle and the distance between the blue and the gray indicate the pace of growth in that region. So here in a 5-year span, this is the significant growth of Africa's middle class. Now let's compare that to Asia, which of course was the fastest middle class in the growing middle class in the world, which thanks to China. But we see that the size and the distance of those circles show that it's the fastest growing middle class in the world. So now let's take a look at US and Canada. If we take a look at the US and Canada, which is right here, we can see that the overlap of the circles actually indicates that the growth of the middle class will actually stagnate here in the next 5 years. So again, the reason why we've seen tremendous growth in the US is because of the fast growing middle class. And the reason why we continue to see such fast development out of China is because of their growing middle class. That trend will hold firm for Africa as well. Africa's young population is connected. So in just 2 years ago, it's reported there was 456 million people with mobile phones. And in just 5 years' time, we'll see that grow 4.6% to 623 million individuals with mobile phones. Over half of those with mobile phones have a smartphone. So it's not just feature phones anymore, but more and more people are getting smartphones on the continent. Just 2 years ago, it was only 239 million people, and that's expected to grow 10.6% in 5 years to 483 million people with a smartphone. That's really important. So the rising middle class is driving consumption. They are ready for technology-based solutions, and they're also ready for technology that introduces luxuries and lifestyle upgrades into their lives. So that's the opportunity. Now, as an investor, like I said, I would be remiss if I did not mention the risk involved in investing on the continent. And so the first risk is actual product market fit. And a lot of startups, especially those that have founders that are expats or coming into the continent, think they can copy and paste a solution that worked in one part of the world or US or Europe and come into Africa and just implement it. And what we've seen is that it's not enough to copy or paste and leapfrog solutions from the West into other countries. So the cornerstone of our due diligence process, something that I want to make sure I see in founders when I'm looking at opportunities for clients and for myself, is that we make sure that the founders and the founding team understands the nuances in consumer behavior that are currently in their markets. So we made an investment in 2018 in a company called We Move. They're actually a transportation and logistics company. And, when I met them, they told me about their business model, and they're doing drivers for hire at the time through your mobile phone or through the web. And I asked them, why wouldn't you just be able to do it all through your phone? Like, why are you giving people the ability to call you or to, send a text message? And they explained to me that the Nigerian consumer is not fully online or it's
This
not
was
fully
one of the
global,
majority's fault for
that
freedom.
they actually
5 years in
trust
prison
more
for fraud.
talking to somebody, and they would prefer that they would be able to call or even text over just doing everything in an app on their phone. And his understanding of the consumer, and the evidence of that is when we saw Uber entering Nigeria in particular, they didn't do as well as they thought they would. And they actually have left Lagos in particular. They've left Lagos altogether. And it's because they didn't understand that nuance in customer behavior is very different than customer behavior here in the US. So when when we saw that, when we saw what happened with Uber, we went, we, it was one of the factors that led us to make that investment. So understanding the actual market behavior and the market fit is a risk that needs to be mitigated. Another risk is just distance from the investment. So I know many angel investors who want to be close to their investments. They want to be in the same geography. But I think that besides, I think this is something that's, thanks to the pandemic, is a risk that has been largely mitigated as folks have now been very comfortable doing Zoom teleconferencing calls. We have been doing this in our business for quite some time, but we also, obviously, with a lot of travel, I have a lot of partnerships on the ground in both East Africa because of my investment in Uganda, and in West Africa because of our investments in Nigeria. So we've been way ahead of the curve in terms of making sure that not only are we connected with through partnerships and on the ground with the folks on the ground, but also just in terms of using technology to communicate and stay in contact with the founders and CEOs of our investment companies. So I think, considering the times, this risk is becoming increasingly less prevalent. And then the final risk that I lay out, that I lay out, is capital utilization. So a lot of companies, and this is not just in Africa. I think this is inherent in most startups. Are young folks who, when you're infusing their companies with cash, just a lot of capital. So we mitigate this risk by delivering capital in tranches based on milestones that are agreed upon at the onset of the investment between us and the founders. So as they are reaching milestones and growing the company, then they are receiving more capital as well. So that's how we mitigate this type of risk as well. So finally, the funding landscape. So the investment process. The investment process is exactly similar to the one that you would utilize if you're investing in a US based company. You want the company to be incorporated. You want to know if you're investing in what we call a priced round or in a safe. So a priced round is if you're getting equity outright, or a safe is when you get equity upon the company raising another round of funding, which is a vehicle that is used widely in the United States. It's also being utilized more and more on the continent as well. You can invest directly as an individual, or you can invest through an SPV, which is a special purpose vehicle, if you wanted to pool groups of individuals together. You can invest in any size around, depends on the company. Checks can be, investment sizes can be from $10,000 US. I've done investments as low as 2,500 as an individual investor, so that possibility is there. And then we get monthly updates after we make our investment. We get monthly updates from the investor, how the company is doing, what progress is happening, and what are the challenges, or what kind of needs do they need, what kind of if they need introductions to partners, did any introductions to possible clients. Those things are what we as investors help with as well. And we're also just a sounding board and advisor for the companies too. So now, how do we exit, right? So this is an important, we making an investment, we want to know that we have a return and that we can get the return back to us as we sit here in the US. And the great news is that most countries repatriate US dollars for free. Um, most countries do. And then there are other countries where you have to be a little bit more thoughtful. Like Namibia, it's easier to repatriate South African rand. Egypt and Kenya is also areas where it's difficult to, I wouldn't say more difficult, you just have to be more thoughtful about how you repatriate your funds. Just be more aware of what those, if there are capital controls in place, what they are. So that is the investment process. Again, it's very similar to what we would do here in the US. Now, as I wanted the fund managers, or the amount of funding that's on the continent. So because of the nature of our markets, it's a developing or emerging market. There's been a lot of private equity has been on the continent for decades, right? And so there's over 100, there's 126 private equity funds currently in Africa right now. And because of the proliferation of the tech hubs that we talked about earlier, there's 3 times that amount of early stage funds on the continent right now, 332 early stage funds that invest at that pre-seed and seed stage that I showed earlier. And quite amazingly, there's almost no growth stage capital based in Africa. So you have 332 early stage funds funding all these startups. You have private equity that's, waiting for these startups to mature and get to them, but there's no growth stage capital that actually gets companies from the early stage to the stage where they can be attractive to private equity. So for this reason, I'm launching 321 Ventures as a venture capital firm that's catalyzing the growth of entrepreneurial activity in the large markets of the global South by filling that gap of growth capital in the funding landscape. This is my team here. Meseret is an Ethiopian woman who's got a lot of experience in that market in particular. And Anessa is our junior associate who does modeling, financial modeling for us as well. My track record since I've been investing in Africa, I have an unrealized return of 3x, and it was at 4x, but we made a couple investments this year, so lowered that a bit to 3x, and 43.3 IRR. And we just started investing as FM Capital Group. We just started investing in 2017. So we're excited about the projection of the startups in our portfolio. And we're talking to a number of companies now. We're actually in due diligence with 2. We looked at that. We're on track to make 2 or 3 investments at the top of 2021. So really excited about the kind of founders that I'm seeing and want to really further the funding work that we're doing with this new venture capital firm. So any questions? Just lastly, I'll just say as an individual, we still take on clients who are interested in doing venture capital, want to invest with the group, with the syndicate, which is what we provide through FM Capital Group. So thank you.
Okay, I'll ask a question in case there aren't any right now. I mean, but the floor is open for everybody to ask questions. Please feel free. I know it's a lot of financial statistics to absorb, but it really clearly shows the advantages that are there in Africa. So maybe if I could put it this way, how can we benefit from those from the markets in that southern, the southern markets, and particularly Africa? How can we individually, I mean, we might not have the 1 millions, the 2 millions, but then you also came down to the lower numbers. Maybe how can we benefit from that, especially as a small group as we are?
So the millions of dollars is the valuation. So we want to see that companies are increasing in value. So those were the millions of dollars. But thanks to technology and social media, like all of that has democratized. So we don't need millions of dollars to invest. I put a number out there, $10,000. Pull together, if you have 5 interested investors, that's just $2,000 per investor. And so that's what I recommend, is that you co-invest, that you don't invest in a startup on your own. So to mitigate your risk, to mitigate your risk is really to, not put up as much money as you would if you were going in by yourself. So if you were going in alone, you would invest $10,000. If you all pulled together, you could bring that number down to $1,000 per person, right? And do a $10,000 investment or more. If you had 10 people who all wanted to do 10,000, that's $100,000 investment, which is a substantial investment when you look at the total investment. But when it's taken as per individual, you de-risk it significantly for yourself. So my advice is always to co-invest. Whether you go as with an individual, like invest with someone like myself, who is an advisor, who is licensed to make sure you're making investments that are in your best interest. And then to co-invest with other individuals so that you're able to minimize or reduce your total investment size as an individual. So again, instead of doing a $10,000 check by yourself, you can do $1,000 or $2,000 check by yourself, pooled with other people. You're on mute, Inambao.
Anybody else with any other questions? Mr. Elias, Bakubi, Maya, Mr. Sam, Pastor Sam over there, Wakasi, Derlia, I see Chishimba as well.
Well, thank you for the information. It's a lot to it's each section that you covered has its depth on its own, and I know I have lots of information. But the question is, did we record this to go back and re-listen to it, Mr. Inambao?
Yes, it's being recorded right now. Yes.
Okay, so at some point when we re-listen to it and take some notes,
and make sure that I'm presenting the strongest companies to my clients.
The floor is open for questions, comments. You're on mute. You're on mute.
I said I like the point that you just made, that bringing money into the company is one thing, but being profitable is another. I think we are so focused on bringing money, but again, the question is, I think when it comes to investment, the point that you just raised is this company profitable? Yes. Because profitability defines the strength of a company, and right. And how deep they are into what they do. So I think it is now one thing that I would look at is I want to look at their profitability, how they are well invested in their product. Yes. Thank you for that point.
Yes, I will say on that as well is that in the beginning of any company, profitability is not going to likely be there. It's not going to be there. That's why they're asking for investment funds, right? So, but what we want to see, that is there a path to profitability? Like that's even greater. It's not like Uber. Like if we go back and pick on Uber again, Uber grew really fast. It's making billions of dollars and it's not yet profitable. So those are, we want to make sure that we're investing in companies that we see a path to profitability. And some investments some companies that are not invested, that are getting investment dollars but are not profitable, is because the investor sees a path to exit. So that's a totally different criterion than wanting to see a company get, profitable, grow, and be healthy. Is if you're as an investor only looking at the fact that, okay, well, Uber's going to IPO. I don't care if they ever get profitable as long as they IPO and I get my money back. Well, then that's a whole nother investment thesis as well. And it's valid. I mean, it's valid. It's capitalistic, but it's valid. So I just wanted to expand on that. Like, in the early stage, especially as angel investors, we come in really, really early. And so we're likely not to see profitability, but we want to see, are you making money? Because, you know, that indicates that your service or your product is actually serving an actual need. And we want to understand how they're spending that money, so we can understand what that path to profitability will look like.
So just to clarify, not for other people particularly, also, is that because there are people who want to start business, but when it comes to starting a business, you're talking of investing, you know, developing your project plan and investing so much money upfront to build that foundation for you to get to the profit place of profitability. In your case, you're saying basically there's more advantage in investing in a company because you already do the groundwork, right? To determine which companies are actually making profits. So you would reach out to us and say, hey, bring your dollars and invest them in these companies because they are making profit, and then you guarantee a return. Can you clarify? Am I on the right path?
Oh, and working with me?
Yes.
Oh, okay. And working with FM Capital Group. So our process is that I present opportunities, companies for investment on a quarterly basis.
Mm-hmm.
And from there, I'll present, you know, or you come to our meetings, you present, you watch the meetings, you participate on the presentations. And if you find interest in a company, if there's enough interest from the group, I will bring the founder in to speak to the group directly. And so he and I, or she and I, will have a conversation about the company. Sometimes they'll share their screen and do a demo of the product, and it allows you all to also join in with questions, with comments, with, you know, with concerns, what have you. So you also have a chance to interact with the founder of the company as well. If there's further interest, then we enter due diligence. So it's not that I take your money and invest it into companies, or I even tell you that these are companies that you should invest in. Everyone is able to choose which investments they actually want to make.
Mm-hmm.
So I might be really excited about a company and nobody else is, then there's no investment to be had. So um, so uh, um, if there's interest, then the founder comes in. If there's further interest and you're ready to invest, then we enter due diligence. And that due diligence process is essentially when I do background checks on the company and the founding team. We want to make sure that the company is the company, that they're doing what they said they were doing, and that the individuals are who they say that they are. And so when due diligence checks out, it's then that we invest the money. I ask for investors to send the money to me so that I'm able to make the investment on their behalf. And then after the check, after we invest, we receive monthly updates from the company, either in the form of email or on a call, much like this. So no, so my answer would be no. My process is it's very much an involved process with the investor. You don't give up funds until everything checks out. We even when due diligence checks out for me, I present those findings to the actual syndicate. So it's going to be like, there's 11 of us on this call today. Maybe 5 of you are interested. I go into due diligence. The 5 of you then with me get on a call and I present my findings on due diligence to you. All right. And so make sure that everybody is comfortable. And then we sign an agreement that creates a syndicate between the 5 of us or the 6 of us, and then you send me your money for investment to invest with the company. So it's there are different models out there where they're much like what you said, you know, about like they do take your money and say these are the companies you have to invest in, these 5, and that's what it is. My process is not like that at all. One of the values of our company is that we create informed and educated investors, and so we make it a point not to just take your money and invest it on your behalf, but to involve you in the investment process. Now, I have clients who are like, here, Lydia, invest it for me. I trust you. And that's fine too. And I still send them emails about the investments that I'm making on their behalf. Because again, our value is that you be educated, that you be informed about what is in your portfolio. So no, I'm not going to just take your money and make you invest. I'm going to present opportunities to you from From there, you will choose which opportunities that you want to invest in. And then we make sure we do our entire due diligence to make sure everything checks out. We've had deals fall apart in due diligence. We've had, companies that weren't actually companies. They weren't incorporated. Can't invest if you're not incorporated entity. We've had deals fall through because the terms were changed at the last minute. People didn't feel comfortable anymore, and so we pulled out. So that due diligence process is extremely, extremely important to me. And so, I'm a fiduciary of my clients' money, and as much as I want it to grow, I want it to also, make sure that we're doing, safe and eventually profitable investments and impactful investments as well.
Hi, Lydia. My name is Maya.
Hi.
Hi. I just want to thank you for this very important information that you presented to us. And I just want to mention that I'm very, very familiar with angel investments. And actually, I have invested in about 3 small startups. Nano is a daycare kind of little company. I think I invested about $200 2 years ago. It's still a startup. It's money that I didn't mind to lose. And then I also invested, I think, about $250 in maybe Sour Robotics. It's also another startup. They are trying to do some, whatever. I'm sure you understand. So. Yeah. I'm very thankful that you brought this information, and I would like to follow up with your information and what you do. Maybe the only question I have is, do you charge for your services? Because you are saying you shed more light in these small startups. I've invested on my own, small amounts just by reading about the startup, and then I'd say, well, let me give it a try. It's very interesting, and go from there. But you are saying you meet with the founders and bring more information. That's very, very exciting.
Yes, thank you so much, ma'am. I'm so happy that you're angel investing. That's awesome.
I am.
I think everybody should have venture capital in their portfolio. I say that it is the wealth creation vehicle of the 21st century that real estate was for the 20th century. And so if it's suitable for you, you should be invested in venture capital. Yes, I do charge for my services. So if you are coming to me and you just want venture capital in your portfolio, that's all you want, it's a $500 annual fee. If you are coming to me for all of your asset management needs, I also do traditional asset management, retirement, your brokerage accounts, angel investing, real estate, whatever it is. If you're coming to me for all of that, then that $500 is actually a retainer fee. And then there's an annual fee based on the total amount of your all the accounts that you want me to manage for you. Venture capital is a piece of that. So it just depends on what you need. Some people are comfortable managing the public, public equity or public market, public security side of their portfolio, but want a lot more guidance with the private market side. And so they will just come to me for that. Again, that's a $500 annual fee. If you want me to do a more holistic approach to your portfolio to make sure, because I take a holistic approach. I'm not looking at just your retirement in isolation, your IRAs in isolation. I look at all of it, and we create a plan that uses your accounts actually very strategically to achieve our your financial objectives. So again, if you wanted me to do, the whole holistic approach, just adding venture capital, but also managing other investment accounts that you have, then the $500 is a retainer fee. It's one time. It's a one-time retainer fee, and then there's an annual fee that's billed out every 3 months. We bill out an annual fee. So it starts at $375 per quarter. That's that billing out. It's a $1,500 annual fee, but we bill it at $375 per quarter. That's where it starts. So it just depends on the size of the total of all of the accounts. And then I'll say that if you're just coming for venture, that $500 is annual. So you will pay that for the full 1 year that you stay on with us. Thank you for asking.
Thank you for asking, Maya. That was a good question. And thanks for clarifying. Are there any more questions? Any clarifications? I hope we all understand angel funding and the service, what the benefits behind it too. Um, another thing is when when you do your part in the on the angel funding, I mean, what your contract, it talks about the your exit, right? Like when you're like, hey, we've satisfied, you're happy with what's going on, and then you step out or whatever. Could you explain that process, like the timing? Or
Yes. No, that's a great question. So for angel investments, I wish we could control and we could step out of an investment. So that's not not our control. The way we control that is by advising the founder, staying in touch with the company, staying in touch with the founder of the company, and helping them navigate their different fundraising rounds. The time frame for our investments is much longer term investment. It is an average 10 years. It can be, I showed you some of the shining examples on the continent where investors in those companies received an exit in 4 years. I think 10 years is an average venture capital investment. It's a 10-year investment. You're hoping to get your return within 10 years. Since we're in Africa, we're in Latin America, we understand that these are more emerging markets. I like clients to expect more of a 10 to 12 year return timetable. So, and then exits, I'm glad you asked that. So the exits happen when a company either IPOs on a stock exchange, gets acquired or by another company, or what's really been happening, particularly in Africa, is when a much larger investor, like a private equity firm or a venture capital firm, invests in the company and buys out the earlier investors. And so in some of the companies that I showed you tonight, that's what we saw when we saw partial exits. We saw that a larger investor came in, made an investment in the company, and bought out those other investors, thus exiting those investors out of the company. So we actually don't control those events. So that is incumbent on the company
on the
to
performance,
determine,
right?
on the performance of the company, and whether they, based on their performance, want to agree to it being acquired. They want to go ahead and IPO for more capital, or they do terms with the bigger investor that will effectively buy out us that come in at the earlier stage. So, and so those are things that, as I maintain contact, which is why we like to have monthly updates with the founder. I'm constantly talking to the founders in our portfolio to not to make sure that we get an exit, but just to keep us top of mind for them, so that they, if there's an opportunity that we can be bought out because a larger investor wants to come in, they will see, they will take care of us and make terms such that we would get a return and exit the company. And so we're seeing a lot of these, what I call engineered exits. A lot of these have just been happening in the last couple of years. And it's a trend that, particularly in Africa, is definitely one that will continue to happen, especially as our stock exchanges on the continent are still a little not as liquid as the New York Stock Exchange, London Stock Exchange, right? And so these different kind of ways are exit. Again, they are controlled by the company. It's incumbent on the company to make these moves, but we can be the neck that kind of turns the head and influences some of these decisions as earlier investors, mostly because we took on the risk. We took on the risk that those bigger investors weren't willing to take on because we came in so early. So usually founders they're amenable to having us exit out when a much larger investor comes in. So that can happen, and that can happen in 2 to 5 years. Really, that could happen much quicker than a traditional exit that typically happens here in the US. In the US, we'll see more, it has to be an IPO or an acquisition, like that's it. You don't really see investors buying out earlier investors, but that is what's happening on the continent. So it's actually kind of exciting to have an opportunity to exit in that way.
All right. Any more questions? The floor is still open. I think we've kind of done an hour. We had set the speeding for an hour, 30 minutes, just in case there was a couple questions. Mr. Jenkins Anderson there. Any questions, sir?
Thank you very much, Nabal. I don't have a lot of questions. I just want to know if this call has been recorded, so we can go back and I kind of joined a little later. I just want to know that I want to find out if it's being recorded, so we can go back and watch the feed.
Definitely, it's being recorded, so I'll be able to share that with you later.
Okay.
I'll share it with everybody who's yes.
And I see that she had shared her email. Awesome. I think she also posted her email address in the chat, right?
Yes, we can. We can reshare that.
Okay, awesome.
Okay. Yeah, please feel free to reach out to her
individually.
And yeah, she's I'm selling her out, right? She's available to answer your questions. And honestly speaking, it's not just about her company. She can advise you on any other directions, and she's a great resource. And definitely you're free to ask her about her company, which is great. She's assisted me. I was asking, actually, the first question I asked her, I said, hey, I have this organization and we need money, to get us to the next level. How can you help? And, she kind of walked me through the parameters and what determinations they make and what is needed. And I don't know if, I know you probably didn't break it down in that perspective. Maybe you could share that a little bit as a final thing for everybody. I mean, like what criteria you're looking for, like if at all someone were to come and say, hey, we want some angel investing in our company or in my business or startup.
Yeah, I don't lay out any criteria. I just ask a lot of questions. I just that's what I do. It's like, I'm an investigator. I mean, let me just, I'm learning. You kind of tell me. So I ask a lot of questions, and it's just I can reiterate. I ask questions about their numbers. How much money are you making? How much money are you spending, and what are you spending it on? I want to understand how they are getting customers. How are people knowing about the service or the product so that they can buy it? I want to know, if they have employees. I want to know what problem they're solving. And ultimately, like the biggest thing is like, why are they doing this? Why do you want to build this business? Because entrepreneurship is not easy. And so I don't want to see that, you get $500,000 in funding and you don't build this business, So it's really important that I understand why the founder got into this business, what his or her background is in this line of work, and what they believe they are solving with the business that they are building.
That's a good answer. So basically, we should market ourselves good enough to benefit from the process. Basically,
well, just building
for the mutual benefit.
Yeah, you don't have to market yourself. Just build an amazing company, and
exactly
the money will come to you. Quite honestly.
Okay. Yeah. So yeah, at the end of the day, if they say the best, the most successful people are the people who solve problems, right? Who create the connections that solve problems. So my encouragement to everybody on the group anyway is let's share those ideas and hopefully those ideas are solving a problem and making a difference for other people, then we become more attractive to investors, and we find that we're more successful because we'll have all the resources that we need in order to, to break through. Yeah. Well, if there aren't any questions, I might have to round this up in a minute or so. Are we, is everybody okay? Are we good?
We're good.
You're good. Thank you very much. If there aren't any questions, really appreciate. So, Lydia, really appreciate. I know that you're a wealth of information. You made this time for our group, and I really am excited that you were able to get on. And thank you very much. Thank you, thank you. And whenever you have any conferences and any other activities like the Innovate for Africa, please, remember us. Just share those links.
Yes,
yeah.
Absolutely.
Yes.
Thank you again for having me. Thank you all for being on the call tonight. I really appreciate. You can tell I love talking about this stuff. So thank you so much for having me.
So we've learned a lot. We've learned a lot, and thank you so much. And thank you, everybody. Mr. Elias, Wakubi, Maya, Colleen, Rakasi, Brother Jenkins, Pastor Sam. Thank you very much for just being on the meeting, and I hope you're inspired. You've learned a lot. Feel free to reach out to Lydia. Thank you.
Thank you.
Good night.
Good night. Bye-bye.
Thank you and good night.
Good night.